People have to register and it's going to a form.
For next month?
Yeah, for next month.
Okay.
They must register, so.
Do you want us to register too?
And
Yes.
Barry, I would imagine we are back in person, we're probably going to be doing a list.
Yeah, they register and they will, yes,
Okay,
we'll talk about that later.
Yep.
So, got some people jumping in.
Hey, Snoop Dogg.
I'm
What's up,
here.
Jay?
How's your Tuesday morning, late morning?
It's okay. Hold
It's
on.
okay.
Where is it?
Mhm.
Turning out. Let me find it. Hey, Teresa.
Oh, I see Ashley. And Betty and Diane. And
There's
Diane.
Sheri.
Feel like that's that from Romper Room. I see Bobby. Am I dating myself here?
I know exactly what you're talking about, Barry.
Yes, I
I'm
know.
sure there's a few here that don't know that.
Yeah, I know. I know. We got some young ones. There's Sheri. Hi, Sheri. Good morning.
there she is. Yay.
I'm on mute. Am I mute? Hold on. It's okay.
Hey, I'm off the hook. I don't have to do the speaking. Thank you, Sheri. I was totally gonna fudge through it.
Yeah, Sheri, Delyn and I were prepping our material.
No
'Cause
need
we
for that.
We were worried. I'm like, I sent her the link like 3 times. I hope she got it. And then I called you and left you a voicemail this morning, just in case.
Yeah.
So we had a Zoom call with a coaching company, and our guest speaker was stuck on a flight. This was that last month we did that?
Yeah,
So
I think-
yeah.
Yeah, it was. No,
And of
I think
course
it
we
was February, wasn't it? I
It's
think it was
February, yeah.
February. Yeah, because March we were in person.
Yeah, so yeah, it was interesting, but we got through it.
Yeah, we did. There's always a way. There's always a way.
So Jay, I think you are what time is it? It's 11:29. Jay Snoop Dogg is one of our sponsors. So Jay, I'm going to give you the talking stick for 30 seconds or so to let everybody know.
Did you say 30 minutes? Is that what you said?
I did. I said 30 minutes. That's exactly what I said.
Well, I'll just introduce myself. I'm the owner of A Snoop Inspection, been inspecting for 12 years. I have multiple inspectors in the area. We actually cover inspections all the way up to the villages, across the Crystal River, down to Venice Beach. So if you guys need help there, I have contractor experience. I've been in construction for 38 years. So feel free to give us a call. You can hit me up here and chat if you want my number here, or they have all my information. Delyn, Barry, any
Yeah.
one of them can get you in touch with me.
But Jay, feel free to put it in the chat, okay? So people can
sure
just jot
will.
it down.
Yeah, for those of you who we don't know, we'd love to send out. There's a new, just an FYI, there's a new rule on texting now. You will have to opt in for us to be able to text you. So our program does that. So if you didn't get a text today, there's a reason why. So we're going to, we'll get that sent out to you. So for next month, we're going live in person. And, we pay attention to all the surveys that you all send us. And social media is the one thing in marketing you all want to learn about. So next month we'll be live in person. I'm going to post the link in there that you can all click on. to join us. We'll be at Carrabba's next month. It's May 9th at 11:30. So please put that on your calendars. I'll remind you of that coming up. So we got a few more people logging in. We'll give them just a minute. And then we'll let Sheri Nedley go and take over. Sheri, thanks for taking time out of your busy schedule.
Of course, no problem.
Jay, real quick, you got a question in the chat box.
I mean, just real quick, I'll tell everyone, we work all the way up to Citrus Lake, down through Sarasota. So, I mean, the whole Tampa market. I'm here in Clearwater. I've got a guy that lives in Bushnell. I've got another guy here in St. Pete, and we're bringing one of our old guys from Zephyr Hills. So we cover the whole area.
I really have a dumb question for my tech people. So I have this link on my phone. I guess I have to get in and cut and paste it out of email. So I have to leave the screen to do it. So I'll get that link over to you to sign up for this one. I answered my own question.
Barry, just wait, I'll email it to you.
You have that?
I'll give it to you in 1 second.
I have it in my email. Okay, I think we are starting. This is being recorded, so we will edit it and get it out for those who missed it. Thank you all for joining us. I'm Barry Horvath. I'm the branch manager over here at the mortgage firm in Trinity. And I know we have Connie Walker on with us. Connie, say hello.
Hi, everybody. Thanks for
We have,
joining.
thank you, Connie. And we also have Lynn Gaston here on the team. And we
Hello,
have,
everyone.
I see Michael Stanley is on. He's one of our loan partners. And we also have Lisa Odom on here.
Barry, it looks like you got muted.
Barry, you got muted. Unmute.
The darn-
So pick it up from, we also have Lisa Odom.
Can you guys tell how well polished and rehearsed this has been? So we have Gigi from Dynamic Title also on. Gigi, it's just Gigi's waving down there. And I know Candy is on here, and just also from Dynamic and Elite Closing Group. So thank you all for joining us. So Candy, you want to say hi?
Hi, everyone.
There you go.
And you forgot Stephanie, who runs this whole thing for us.
Yeah, he's the brain of the operation here.
So anyway, thank you all for joining us. We'll try to be respectful of your time. I know Sheri, Sheri's the vice president of our capital markets with the mortgage firm. She's actually in our corporate office, and we invited her because one of the biggest challenges and questions we have right now, and obviously all of you are facing it, what's going on with the rates and why they're doing what they're doing and where are we going with that. So she's in that every single day. She deals directly with Fannie and Freddie. Remember, we're direct sellers to them, and FHA, and she can give us some insight into the market, what's going on and what we can expect in the future and what kind of adjustments we're seeing on pricing. And without further ado, Sheri's one of the most knowledgeable people you'll ever meet. She's the go-to for us at the mortgage firm, and she just does a great job. And I don't know how many years you've been with the mortgage firm, but I know you've been there. Is it
June will
over?
be 24. So I've been with them for 24 years in June. So
I was gonna say 23 years, so.
Yeah.
Yeah, that's all, and that says a lot about her knowledge and wisdom. We've only been around, this is 7 years for Dylan and I, so we feel like by far the best company we've ever been affiliated with, and we're proud to be partnered up and part of their team here. So Sheri, without further ado, I'm gonna give you the talking stick and let you
Okay.
share all of your information and wisdom. So thank you, Sheri Nedley.
of course. So there are so many factors that go into where we are with rates, especially in this economic landscape that we're in, coming out of COVID and everything that happened, with COVID and the Fed dropping the overnight fund rate to 0 and leaving it there for such a significant period of time. And then inflation becoming realistically out of control, and then realizing it was out of control and then raising the rates. So there's been this massive swing from one extreme to the other in these last 12 to 14 months. So it's very hard to predict where we're going from here, right? The Fed itself relies very heavily on data. One of their favorite indicators is the consumer price index, the CPI. This is one of the things that they kind of look at on a monthly basis and make the majority of their decisions based on how the CPI looks. Problem with the CPI is it is behind what is actually happening, and they look at it on a year-over-year perspective. So the CPI actually comes out tomorrow at 8:30 a.m. So in my opinion, it is going to be higher than they're anticipating. And so the market will react in that way, that they'll think inflation is going up. The reality is inflation is coming down. All the other numbers out there, all the other economic data out there are speaking to the fact that inflation is actually dropping. It's not going up. So you're going to see a mixed bag of what could possibly happen tomorrow and probably in the next 3-4 weeks until we get to May CPI. That CPI is kind of the turning point. According to most experts, May is where we kind of turn that corner and start seeing an actual drop in year-over-year inflation. So it's really, for us in this industry, it's kind of a hold on for another month in what could happen and what the Fed might say, what they might do. So last week we had some really good economic data from the jobs report, employment, and everything else up until Friday when the JOLTS report came out. And that one was the opposite of what all the other indicators during the week had been. So we had some actual improvement in rates Monday, Tuesday, Wednesday. We were very flat on Thursday. Friday was a short trading day. The market was only open till noon, and we had that JOLTS report. So we had a pretty big swing on Friday in rates, and then we've been flat again yesterday and today so far. So everybody's kind of holding their breath, waiting for CPI to come out tomorrow. That tomorrow would be, in my opinion, a terrible day to lock. If you have a loan to lock, today's the day to do it. You're much better. There's so much more to lose by not locking than there is to gain by waiting to see what the market might do. And that's my philosophy across the board, right? So, unless there's something huge out there looming that is going to improve the rates market, you always are better off locking. We have plenty of opportunities to improve the rate for the borrower. We have a rate renegotiation policy that is very market friendly and borrower friendly, that we employ quite often to help improve the rate for the borrower as they progress through the file flow. So again, it's just, this has been the best word is unprecedented, right? It was what was used all through COVID and everything else. And where we are now is truly unprecedented. So we hedge, which means we kind of insure against market movement up or down with our rates, right? And most mortgage companies do. Anybody who's not is taking a huge financial risk by not hedging. In part of hedging, you're buying out a book of rates, so to speak, for 3 months. In the past, the difference in price between those 3 months of hedging was about 30 basis points, right? So the price between the 3 months would be different because the market would move and there was anticipated movement up and down and people could kind of forecast where we were going in a 3-month period. Now, those costs are exactly the same for all 3 months. We've lost that 30-point difference in those months, which is very unusual. That means that there is a lot of uncertainty and a lot of unknown as to where we're going. So they're pricing it all the same because they just don't know which way it's going. Okay. Does anybody have any questions about what I've said so far? Okay. We anticipate that that's going to change probably in the next 6-9 months. You know, the Fannie Mae has forecasted a recession. They predict that it's going to be mild. They believe that it will affect the market more towards the end of the year. Typically, a recession is good for this industry, right? Where we kind of benefit when other people start to lose, unfortunately. So we're, as somebody had described it once, we're on a roller coaster. The economy is a roller coaster. We're in that very front car. We feel that downturn first, but we also experience the up first. So when the rest of the economy is truly feeling a recession, we're already feeling our recovery as an industry. So there's a huge push now for affordable housing, affordable lending, and we're a big participant in that. We're actually one of the top 3 lenders in the state of Florida for Florida Bond, including Hometown Heroes. Those, you know, with those programs, I don't know if you all have seen, but they actually just announced in the last couple of days, Governor DeSantis approved $100 million additional funding for Hometown Heroes. And starting on July 1st, they're removing the overlay of occupation. So it used to be that it was only for certain occupations. They're removing that overlay. So now it is available for any first-time home buyer, which is huge. That's a huge change. So we've got, you know, we've got some really great things in our future, you know, over these next 3-6 months, and the prospect of the market making a shift in our favor rate-wise. We are going to probably settle somewhere around 5.25, you know, somewhere in there is where rates will settle. There'll be some fluctuation, obviously, in either direction. Probably in the next 12 months is where we'll see ourselves settle into that. It would take rates being in the mid-3s for us to have another refinance boom. They do not anticipate that happening. So we'll probably get into the 4s for a short period of time towards the end of this year, beginning of next year. And we'll obviously see, you know, some significant activity through that. But then they will settle, like I said, somewhere in the 5s, mid to low 5s. So, Barry, is there anything else you'd like me to cover or questions you have?
So I have a couple of quick things. So Sheri, if we could like back up a little bit. So, you know, we got down into the 3s and that was kind of like I guess for all intents and purposes, when you look at this in the long haul, you know, I've been doing this since 1980. So when interest rates were 18%. So I've been watching them tick down for the last 40 years. Getting down into the 3s was not sustainable. Is that correct?
Correct.
And if you can go into why, so that we kind of have a background as to, you know, why and why it's better that the rates are up.
So, you know, we're not directly tied to the Fed fund rate, right? But, you know, we are more closely tied to the bond market, and the bond market does kind of react to what the Fed fund rate does. So when the Fed fund rate was at 0, the bonds were also low, right? So the yield on bonds were low. And the agencies, Freddie, Fannie, Ginnie, were buying mortgage-backed securities at a very high rate. They were the biggest purchaser of mortgage-backed securities throughout all of COVID, which helped to keep rates low because they were paying really good money for those books of mortgage-backed securities. Well, when the Fed decided that inflation was getting out of control, which was too late as always, and started to raise the rate, and the agency said, we're not going to be buying mortgage-backed securities anymore, that forced that into the private market, right? So the private market isn't willing to take a low yield like agency would. Agency didn't care what the yield was. It wasn't about them making money necessarily on these mortgage-backed securities. So the private market is only there to make money. They're not buying mortgage-backed securities for the heck of it, right? They want to make a profit on it. So those yields have to be higher, which means rates have to be higher on that mortgage-backed security book.
And just so people know, when you say private, that's basically Wall Street, right?
Correct.
And when you say agency, that is, guys, that is Fannie Mae and Freddie Mac.
Correct.
Because agency, that's who that is.
Yeah. Ginnie Mae, which is FHA, VA, and USDA loans, they do their own, they have their own pools. They do mortgage-backed securities as well, but they don't combine. You do not have a pool that is Ginnie Mae and Freddie Fannie combined. It's all those are separate. The way that they report, the way that they respond, the way that they act within the market are completely different. And they also have different rules governing them as far as how they're serviced and maintained, et cetera, as far as so with agency, with Fannie and Freddie, if the borrower does not make their payment, the servicer doesn't have to make that payment on the borrower's behalf. On Ginnie Mae, the servicer does, which is why it is very expensive from a cash perspective to service Ginnie Mae loans. Because again, if that borrower doesn't make the payment, whoever's holding those servicing rights is making the payment on that borrower's behalf to Ginnie Mae.
Oh, see, I didn't know that either.
Yeah, it is.
Interesting.
Being a servicer is very cash heavy, and they have a lot of regulation, and they've actually been tightening that regulation in the last 6 months or so, and we anticipate that will get even tighter over the next year as the pool of servicers shrinks with the tightening of the market overall. I mean, there's going to definitely be attrition in lenders out there. There has been already in these last 12 months. There will be even more over the next 12. There will be companies that will not be able to make it. They just can't.
The ones that are out there at the low rates or whatever, they're
So,
kind of banking on.
There's a couple
volume.
of companies that were actually really smart and they banked a significant amount of cash over these last couple of years during COVID. And they did that with the specific intent to buy the market when it turned like this. So, there's one wholesaler out there specifically, they banked about $1 billion in cash. And it was so that they could be strategic in where they wanted to take themselves in the future to maintain their volume in a way that helped them to remain profitable, even while using their cash.
Interesting. I've seen some credit unions kind of do something similar, don't they?
So
I've seen
credit
some
unions
credit
are
unions.
completely different. They're just
Okay.
a whole different ballgame, right? So they don't typically sell loans out into the market to agency, to Fannie Freddie. They almost always are portfolioing those product and they're servicing themselves. So when you are buying a loan or originating a loan and you're maintaining that servicing, you're not selling the loan to Freddie, Fannie, Ginnie, whoever, and you're just retaining it. The only thing that you have to worry about from a profit standpoint is breaking even, right? That segment of their business is not necessarily for them to be profitable. It is for them to gain that borrower's banking business, 100% of their banking business. That's their goal. That's what they want. Same thing with banks on the retail side. Bank of America isn't looking to make a killing on the loan side. They're looking to get your banking business because they make way more money off of your money being in their bank than they do off of you having a loan with them.
True. So what other things should we be watching, so to speak, to kind of see which way the markets are? I've been saying for years to people, and you never know, right? I've actually been saying if I had a crystal ball, I'd be sitting in Washington making a heck of a lot more money than I am in Newport Richey. But and I've also said, it seems to run opposite the stock market. The stock market does really, really well. Everybody pulls their money out of bonds, puts it into stocks, and then the bond market starts to tank, which is bad for mortgage rates. And then vice versa, when stocks start going down, everybody puts their money back into bonds, which is good for mortgage rates. is that still kind of in play? Is that something that we can, I've always told clients that if you see the stock market starting to tank, call me. If you see the stock market starting to go, really strong, call me.
Yeah, I mean, there is a little bit of correlation there. It hasn't been as clear as it has been in the past. And so there used to be a much closer spread between where rates are and where the bond is trading at, right? So the bond is trading in the mid to low threes, and rates would typically be somewhere in the fours, to low fives. It would be within, a much closer range than where we are now. So now we're, rates are in the sixes and sevens, and the bonds are in the mid threes, mid to upper threes. That spread is huge. That spread is not typical. And it is because of the chaos of the market and the unknowns and, the kind of double speak coming from, different people within the Fed, voting members, not voting members, the Fed presidents for all of the different, Chicago, Philadelphia, all of those, they all have their own opinion on what they believe the Fed should do, and they don't always agree. So you have, one guy saying, what they call them hawkish when they want to raise rates, and then you have the other guy who is dovish and doesn't want to raise rates or even wants to lower rates. So you have all these different opinions out there on what the Fed should do. And so it's very hard for the market to kind of perceive what they're going to do at their next meeting. Are they going to raise rates? Are they going to stay flat? What's going to happen from a banking perspective, with these two banks that failed that the Fed took over, that is in part because of what the Federal Reserve has done in raising rates so quickly. So, their illiquidity is because of the fact that the Fed fund rate went up so fast that their, unrealized losses from their servicing book were so big that they needed extra cash to cover those unrealized losses. That's part of what made those banks fail, right? So, and that is in part due to the Fed's not having any kind of, a test in place. They needed a test in place as they were raising rates to ensure that banks had the liquidity and, the pieces in place to ensure that they didn't fail.
Do you see, this could be probably way out there, other banks failing same way, or do you think that that's going to be continue, or this corner that we're turning next month, is that going to help that?
So, if we see the CPI come down in May, that will certainly help, because a drop in the CPI is a true indicator that inflation is dropping. And that is what we need to see, right? That's what the Fed wants to see. That will almost guarantee that they will stop raising rates. And that's what's going to kind of stabilize everything. And that's what is going to give everybody that positive feeling that they need to, where rates will start to really come down, and you'll really see some meaningful change as far as rates are concerned.
Sure,
And that
Sheri,
will help banks. Absolutely will help banks.
I think what our realtor partners on here want to hear is that, because they have borrowers saying they're going to wait until rates come back down. It's not likely. I know we don't have a crystal ball, but we're not going to see the threes again anytime soon. And of course, you all know this. I'm going to say this over and over. It's supply and demand. Prices are continuing to rise. And if you're not educating your buyers on that, I mean, Florida is one of the top 3 states. We all know that, where people are moving to, and they cannot keep up with the supply and demand. There is more demand for housing in the state of Florida than most states right now. So prices are going to continue to rise. We're not going to see rates in the 3s. So if people are sitting on the sidelines, they're going to miss a boat. The prices are going to continue to go up.
Yeah, I mean, without something tragic happening, honestly, another pandemic, a massive terrorist attack, a war, like those things are what would drive rates down into those low of a numbers again. And that's not obviously what we want and not what anybody is wishing for. So the likelihood that we would get down into the 3s and 2s again is very, very slim. We'll be lucky to get into the mid 4s. And it'll probably be very short-lived that we would be into that. We are going to realistically, from all of the expectations from people much smarter than I am, they're saying 5.25, 5.5 is where we'll settle when rates finally come down and kind of steady out. And there's nothing wrong with that, right? That's not a terrible rate. In the history of rates, when you look at a 30-year history of rates, the average rate was in the 5s. That's where we average out. So us settling there is actually normal. It's not normal to what we experienced during COVID, and that kind of freaks everybody out. But COVID was not normal. So the normal is mid 5s, low 5s. That's where we're going to settle, and that's what the best we can hope for when we do settle.
Sheri, I have one more thing I've noticed in the market. We have a lot of equity in our properties, and for those of you who know, equity lines of credit have become popular, or HELOCs, where people get seconds. But I've noticed a lot of big banks are actually cutting them out. I saw Wells Fargo's not even doing them now. And I'm assuming that's because of the risk involved of prime continuing to rise and putting borrowers at a higher rate of risk of default. Have you heard anything about that?
It's that, and it's fear of declining markets. So the agencies have declared some areas as declining markets, but there aren't any in Florida that are considered declining markets. And they talk about like Los Angeles, Las Vegas, areas like that where the cost of living is so extreme that it cannot sustain the raise in prices that they had. So they do start to decline as demand comes down. Like Barry said, Florida is still in high demand. I've got a coworker who was selling his home and did an open house. He had 121 people on the first day of his open house. That speaks to the fact that homes are still in high demand. It may not be a bidding war like it used to be, right? People are much more reasonable and they can't afford at the higher prices to keep paying, 50 grand over asking like they were, but there is still very high demand for homes in Florida. I mean, with work from anywhere, which most people have the ability to work from anywhere, you can live anywhere, which means, we are going to be more popular, especially the more brutal the winters are up north. I mean, we will probably get an influx of people from Buffalo because who the heck wants to live in a place like Buffalo with the winter they just had? So, we do see an increase in sales after brutal winters.
We see an increase too when the Tampa Bay Rays are 10-0, so everybody wants to be a part of a winning.
Of course.
Yeah, of course.
I gotta throw my sports thing in. You all know that.
I know.
I have one more question, Sheri, and then anybody else wants to, because I'm intrigued by the markets every day. Dylan will tell you, it fascinates me. Why, and this is important to our realtor partners, why is there a cost now to lock most loans, which means basically borrowers are having to bring more money to closing? I know it has to do with servicing. Yeah, there's points now.
Points. You guys
So
hear
no
the
matter
words
what-
point.
No matter what rate you get for your buyer, it's essentially costing them. Can you explain to realtors why they need more closing costs to get into a house?
Yep. So with the anticipation of where the market is going to go, right? So much of it has to do with forecasting. So the forecasting of the market to have some kind of rate recovery in the next 12, 18 months, right? When this has been going on for a while, even a year ago, in the next 12 to 24 months, they were forecasting a change in rates to go down. Well, that is going to be an opportunity for all of these people who have closed in the mid 6s to mid 7s or higher to refinance, right? So the higher the rate, the less the rate has to come down for them to benefit from a refinance. So, the difference in a rate of 5.5 and 7.5 is about $200,000 in buying power for most borrowers. That is significant. So a change in rate from 7.5 to 5.5 is more than enough to justify the cost of refinancing for most borrowers. So that means that, okay, they bought the house a year ago at a 7.5 rate, the end of this year, the rate comes down to 5.5, they're going to refi, right? So that servicer has made no money on that loan servicing it for 18 months. So it takes about 5 years for a servicer to become profitable on a loan. So they anticipate that their goal is to own that loan or to service that loan for no less than 5 years. So that's the kind of indicator that they use to factor what are they willing to pay to service that loan, right? So they're buying the servicing. So, your companies out there like, Bank of America, Wells Fargo, all of them, they don't buy these loans and own them. They buy the servicing and they're selling the loan to agency. So they're still selling that loan to Fannie Mae, Freddie Mac. They're retaining the servicing. The servicing is where they make their money. It's not on owning the actual loan. So what they're willing to pay for servicing is significantly less than it was 2 years ago. So the value of that loan at a rate above really 6%, in the forecast that we have coming is very little as far as servicing is concerned. So that's why it's very difficult to get a par rate where the borrower is not paying points, in this market. And the volatility, right? There's so many changes going on, in a 30-day period in November, the change in market was so significant that most companies, while they may have made money on their loans, the value of the loans that they had to sell was a huge loss because of that shift in the market. And that factors into what companies are doing, right? What is the value of the loans that I'm holding to close, right? My locked loans, what is the value of those locked loans when I actually close them and go to sell them?
I love hearing the backside of the story.
I know.
It's,
So
definitely
so-
interesting. I came from the operations side when I came into this role. I really came from the operations side. I started off initially with the company as a closer. I was their very first closer forever ago. And so knowing this industry from the operations side and then coming into this side of it, it's definitely a different perspective than you get from most capital markets people. Most capital markets people are finance people through and through. I am not, that I think is what helps to make me a little bit different than my counterparts. And I learned the majority of, what I'm doing in this position actually through COVID. My predecessor, was unfortunately got sick in 2019 and passed away in February of 2020. So when I took over this role was stepped almost right immediately into COVID. So definitely an interesting way to learn. I don't know that I would have wanted to learn any other way because man, did I learn a lot in a very short period of time with how this market works and what really happens with rates.
So if I can ask some other questions that, and I don't know if other people have questions, but ARMs, adjustable rate mortgages, are we seeing a swing back to those? Does
No.
anybody want those? No, nobody
No.
wants adjustable rate mortgages.
No, most
People are
banks
asking me
keeping
for them.
Yeah, most banks are keeping them for themselves on the retail side. And they're not really offering them on our side, where there's just still not enough spread there for them to want them. You can get a good ARM on a jumbo loan, not necessarily on a conforming.
Okay. So they're not really something that customers should be looking to, because people are thinking, well, if I can get an adjustable rate mortgage and the rates are coming down in 12 to 24 months anyway, I'll get an adjustable right now and, lock it in, refinance it.
We're finding that the ARM rates are actually higher than the conforming 30-year rate. You're better off, if you can, to do a buy down of some sort, whether it's an actual 2-1 buy down or to buy down the actual rate. So, and if you have, realistically, if you have the choice for your borrower between a seller concession to buy down the rate for all 30 years or do a 2-1 buy down, so it's a 2-year buy down, you want to do the 2-year buy down. Okay. So, and here's why. Your borrower if you're doing paying discount points to buy down the rate for the life of the loan, and they say they get the rate down to 6. Okay. So over the next 12 to 24 months, 36 months even, rates dip into the 4s and they refinance. They did not get the value of those points that were paid. Even though they were paid by the seller, your borrower still misses out on the value of those points. You do a 2-1 buy down, it's 24 months, right? So the cost of that buy down is realized over 24 months. If they refinance in those 24 months, whatever's left over of that buy down fee gets credited to your borrower's payoff. They get 100% of the value of that buy down, whether they stay in the loan or they refinance. They are getting 100% of that value.
I think that's important for people to know, because the 2-1 buy downs are so attractive,
They
and
are.
sellers, and just to reiterate what Sheri said, sellers must pay those fees to do that. But we can run you what it's going to cost to do that. So what it's ultimately saying is, if their rate today is at 6.5, we can start them at 4.5 for the first year. It reduces the payment substantially for your buyer, especially if you know where price points are today. So
I've created a spreadsheet that I can, have you get a good idea of that. But the other thing I wanted to bring up with this is, keep in mind too, a lot of people don't realize when you're doing a permanent buy down, so to speak, paying points to, buy it down, it is not a 1-for-1. So you don't pay 1 point and you go down 1%. No. It's approximately, Sheri, correct me if I'm wrong, maybe 1/4% in rate per point.
Yes, and it depends on where that rate is. So,
Right.
in their rates are set through coupons. Okay. So coupons are what the mortgage-backed security is valued at. So if you have a 5.5 coupon, that can contain loans from 5.5 to 6 1/8 in note rate. Okay. So that range of rates goes into that single coupon. And so when you get to what is trading most often in the market, which right now 5.5, that 5.5 coupon is the most popular. Okay. You have a 5.5 and then you have a 6. The 6s are okay, but again, they're going from 6, to 6 5/8 or 6 7/8, for that coupon. Well, when rates fluctuate the way that they have, way more loans fit into that 5.5 coupon than fit into the 6 over time. So, your 5.5 coupon, the top rate is 6 1/8. So we're finding that 6 1/8 is actually we're finding that the 6 1/8 is actually better. The way that it's priced on our side is pricing better than 6 1/4, 6.5, and it's better than 6, 5.99, et cetera. So there'll be that kind of one rate that you would think would cost more than the rates below it, but is actually better. So you have to really look at that. As originators, we need to make sure that we're looking at the whole scope of rates, not just focused on one rate, but looking all around it, because sometimes that spread can be so huge between two rates, that you miss the fact that the one right below it is actually better.
Yeah, I always look at all of them and then just play around with them. What if, if I look at this,
Yeah.
what if I look at this, what if I look at that? Yeah, always trying to find. And so that everybody on here knows too, and Sheri, you can explain this, we have lots. So when we pull our pricing up, it has lots of different investors that we can go to that has, and it always pulls up who's the best rate. And I'll play around with the rate to see who's going to give me the best. And there's so many factors that go into what someone's rate is going to be, right, Sheri?
Absolutely. I mean, loan to value, how much money are they putting down, what their credit score is, are they buying a primary residence, is it 1 unit, 2 unit, condo, townhouse, manufactured home, all of those result in different pricing. The loan amount is a big factor. So there's something called specified pay-ups that come from agency. They pay better for loan amounts under $250,000. So, and they have ranges, right? So it's 85,000 and below, and then, moving up from there in these ranges. And the lower the loan amount, the more they pay for that loan. because they're all about affordable housing, right? So they're all about first-time home buyers, and there are so many things in place to benefit first-time home buyers. So there's something called loan level pricing adjustments, LLPA. So those are what they charge for the factors on a loan, right? So the most popular one is loan to value and FICO score, the combination of what is your score and what's your loan to value. So say the LLPA for that is 1, okay? So if you're a first-time home buyer and your area median income is 100% or less of area median income. So for your area, I think the AMI is probably somewhere around like 65, 66. So if you're at that level annual income or below, you're eligible for an LLPA waiver, right? So they give you back that point. 1 point can make a big difference as far as where the borrower is at, right? Dylan, you and I went through this on a loan of yours, right? So
Yes, huge.
where that borrower being a first-time home buyer and qualifying for that waiver saved them 1.5 points. That 1.5 points allowed us to lower the rate by 0.5 point and take away more than 0.5 point of what the borrower was paying in discount. That's significant for a borrower, significant. It can make all the difference on whether or not they even qualify by being able to do something like that. So, those details matter. Are they a first-time home buyer? Having their annual income correct from the start, so we know that they meet that waiver requirement. I mean, if you do a Home Ready or a Home Possible, which is agency's program for 97, so it's a 3% down program, either one of those also qualify for the waiver. The other one, it's called Duty to Serve. So for Florida, especially manufactured home, where they meet that AMI requirement, is also eligible for a waiver. That's a big deal, because the adjusters on a manufactured home are significant. So if you can, reduce or eliminate those adjusters, because of the property type, it makes them so much more affordable for our borrowers.
Don't you love, and I know our realtors hear this all the time, well, my friend got it at 4.5% or whatever. I mean, it drives us crazy because we know all these adjustments. There's no such thing as a cookie cutter rate. The days of Dylan knows, we used to send out rate sheets, right? And that just doesn't happen anymore. There's so many things that, play into the rates and what's happening.
And the rates that they publish out on these websites, when it'll say, oh, the rate today is 6.25 or whatever it is that they're putting, that's a 740 credit score. It's 20 or 30% down every single time. So, it is the best possible credit. It is the biggest down payment. It's all those factors, no MI, no anything. One single family, residence, no adjusters whatsoever. So, that's just not the typical borrower. The typical borrower is, maybe they will have a 700 score, but they're going to be below 740. So somewhere between 700 and 740. They're going to be putting, 5% down, 3% down. They're going to be buying condos or manufactured homes, or,
Right.
there's going to be something different about the purchase that they're making. So the other thing too, we've discussed this, I have sent out emails about this, but if you have somebody who is putting down, say they've got 12% to put down, right? They can't make 20, but they want to put a certain dollar amount down. So their LTV is like 82. It is actually more beneficial to them to put down less money, to go to 85, because the LLPA at 85 is less than it is at 80. So those are things that our originators know, right? Those are the tools and the tips that we give them so that they can educate both of your borrowers, right? As realtors, you want the best LO that you can have, the most educated. The other thing too that I'll put out there is, if you have loan originators telling you that there is a 40-year FHA mortgage, fire them immediately, because they cannot read. That is not true. FHA announced late last week that they will allow a 40-year term on a loan that is in forbearance or in financial distress, and they need to modify. So they're coming out of forbearance or coming back from being unemployed, whatever their reason was for not being able to make their payments. So now they need to restructure. They will allow them to restructure to a 40-year term. That is not a regular loan that, a first-time home buyer can get. It's not something that somebody who doesn't have an existing FHA loan can get. So if you have somebody out there soliciting for 40-year FHA mortgages, they don't know what they're doing.
So funny you say that.
I know.
Minute-
Well,
The
I
minute-
asked her
I got a
about it.
text yesterday. We have a buyer out there, pre-qual, been shopping. And he says, hey, I heard there's a 40-year FHA mortgage. Why didn't you tell me about that?
Yeah, only
Because
if you're
we
already in
don't-
default.
There's no such thing.
I know.
love it.
So-
Let's open it up for questions from any of you all. You can unmute yourself, or if you just want to put it in the chat. I know we're covering a lot of information and it's almost overwhelming, but just know we're here to help you. You don't have to worry about all these pricing things, but I think it's important that you educate your buyers on what's going on in the market, what's the truth out there. And every time the Fed meets and says, oh, we've raised rates, that doesn't necessarily mean mortgage rates went up or mortgage rates went down. Just keep that in mind. That's like our number one thing. Well, I heard rates went up today. Well, not necessarily. Remember, like
They
Sheri
go
said,
up and down every day.
yeah, so it's tied to the bond market. It's nothing to do, while they work in tandem per se, but it's nothing to do with the short-term rate. So your HELOCs and equity lines of credit, absolutely, and that's why there's so much risk in those right now. So anybody have questions? I know you have 100. I'm like, Connie, do you have any questions? No. Come
Not
on,
this time.
Connie's my number one question person, so. Nothing? Anybody?
Everybody's
You guys are
muted.
all glazed over.
Everybody's muted, yeah.
Real quick, I know you mentioned Hometown Heroes and we got more funding. Can you just give the Reader's Digest version, everybody, what that program is? Because you've been great. Sheri actually gets us multiple lenders for niches with the mortgage firm. So we have the ability to actually broker out loans of programs that are niche. And she's done a great job with that. So I have to commend you for, Sheri, all you've done. And I know that's a lot of work. So
Thank you. So the Hometown Heroes program right now is for teachers, firemen, police, those kinds of occupations. It has a very specific occupation list, and it's down payment assistance through Florida Bond up to $25,000. So as of July 1st, they're expanding the program to up to $35,000 in down payment assistance, and they're taking away the occupational override. So it'll be for all first-time home buyers up to $35,000 in down payment assistance. That's a huge opportunity for people who are just on the cusp of being able to qualify or have enough money for their down payment.
and that down payment money is not, does it need to be paid back or does it?
So they have a couple of different options, and most of them are forgivable. It's still a recorded lien against the property, so that if they sell it, I believe it's 10 years, where it becomes repaid over the course of 10 years. So if they sell the property or refinance in those first 10 years, that remaining balance would have to be paid off. But for the most part, over the course of 10 years, it would be forgiven, a little bit over time, each of those 10 years.
That's a great program. So
It is phenomenal.
It's one of my favorite of the down payment assistance programs. I'm not a big fan of them anyway, because some of them are just not good for the borrower in the end. And I try and educate them on that as well. But that one I do like. I do
Yeah,
like
I
And
mean,
that
if your borrower has, 3% to put down and maybe they just need some closing cost help, your best bet is to try to get a seller concession. If they don't have any money to put down, but maybe have enough for the closing costs, then the DPA is a great way, because that DPA does help with their down payment and can help cover closing costs as well. And it's a great route to take. So, but if you have somebody who knows that they're not going to be able to live in a property for more than 3-4 years, their occupation doesn't allow them to stay somewhere for very long, that's not something you want to put them in.
Right.
Okay.
Yep.
And remember, we always set up your buyers in our quick qual system, so you can generate a pre-approval right on the spot when they're ready to put an offer in. So if you have questions about that, we can help you with that. It's a link they have. You don't have to call us at 11 o'clock on Sunday night anymore to say they found their dream house and they want to put their offer in. I know Connie's shaking her head up there. So that's a great that's a great tool. I think it's the greatest tool we have, other than Operation Fido, of course, Sheri. So, but
I love Operation Fido. For those
Yeah,
of
that's
you
a
who
great one. That's one of my
I-
favorites too. So in case you don't know what that is, realtors, that it is it's pet tags. So, once the borrower is approved, we send them a text message asking if they have any pets. They can put in their pet's information. When the loan funds, we actually send the pet a card from our Mortgage from Pet ambassador, which I'm proud to say a couple of my doggies are our ambassadors. And, it's addressed to the animal. It says, hey, I know living in a new area is really scary and sometimes you can get lost, and it's got a little pet tag with the pet's name on it, their owner's phone number, and their new property address. So, but it's one of our most popular things that we do. Everybody just adores it because who doesn't love animals? If you don't love animals, you got to worry about you.
we have a couple questions in our chat, Sheri. I'll read them to you. One is, can a portion of the hometown heroes be used to do a 2-1 buy down?
No, you cannot do a 2-1 buy down on any Florida bond product at all.
Okay. Yeah, the seller must pay 2-1 buy down fees, correct?
Correct. All of our buy downs are seller funded.
Okay.
So before lowering the price of the house, if it's sitting,
Yes.
before lowering the price of the house, please, please, please offer seller concessions, because if they're going to lower it $10,000, take that $10,000 and we'll do a 2-1 buy down and probably still have money left for closing costs too. So,
and I have to reiterate what Delynn said on that. Our smart agents that are having trouble with listings moving right now are putting in the notes that this house is eligible for a 2-1 buy down, or maybe eligible, because people want to see that right now, that a buyer can get a lower mortgage payment by doing the 2-1 buy down, but the seller has to agree to it. So if you know your seller's willing to work on that price, why not put it in there? Because rather than reducing that price by 10 grand and lowering your borrower's payment by like 70, 75 bucks a month, why not lower their payment by $300 or $400 a month? Just saying, by doing the 2-1 buy down. So if you're not offering that, you're missing the boat. And I know you all have a lot of competition out there. If you use, these type of tools, it'll help you. It'll just help you get more listings. It'll help you get more buyers if you understand those things. Because you all know that we have a lot of part-time people in your industry, and we have them in ours. And thank goodness a lot of them are getting weeded out. So they really are. So only the cream of the crop are going to survive. And just for you all joining this, knowing that you're educating yourself, I'd like to think you're the cream of the crop and want to have that competitive advantage. So.
I agree. And I just want to say along with that, as far as, when you're either doing an open house or you have a new buyer or something like that, instead of asking them, are you pre-approved by someone already, just basically say to them, hey, that's great. I'm glad you want to, buy a house or something. Let me have my lender give you a call and make sure, hopefully it's us, that it's somebody that you trust. Protect your paycheck. This is your paycheck. I know every single person on this call has probably had a deal blow up somewhere along the line, or has someone in their office who has had a deal blow up at the last second at the closing table or whatever. You know what? This is why you guys are educating yours. This is why we educate ourselves. I'm grateful to have Sheri, because somebody way smarter than me about the rates and things like that, who can help us out. So just wanted
we have another question. Are there from Luis Perez, are there any programs for buyers with low credit scores? Sheri, I'm going to give that to you.
Yes, we can do programs down to a 580 score. So, what do you mean by low, right? So low is relative. But yes, there are programs for borrowers for us down to 580.
And there's other criteria. They typically need more reserves before when you have that. So they're a little tougher. Sometimes it's better to help get them improved first. But if they find the house of their dreams, we can possibly help them do that. So Okay, any more
Sometimes you're
questions?
better served to help them with home borrower education than you are to actually put them in a home. So it is not always beneficial for us to work that loan to death to get them into a home that they ultimately cannot afford. You know, that is part of our responsibility as well, is making sure that we're putting borrowers into homes that they can afford to keep long term. You know what I mean? The last thing we want is to put somebody in a situation where, you know, one thing happens and, you know, they lose that home. That's not what we want for our home borrowers. So there's, you know, we all, you know, work together in that responsibility to make sure that, you know, we're doing what is in the best interest of the borrower, not just ourselves.
Thank you, Sheri, for sharing that. Anybody else have any more questions? I put the link in there for next month's Lunch and Learn. We will be in person at Carrabba's in Port Richey. If you would like to join us, feel free. You must register though to attend. I have to make sure we have enough food for everybody. And of course, it will be on social media. And we have a very special guest speaker, and you guys will see it on the flyer. Somebody who knows social media better than anybody I know. And if you want to know who it is, just register. So,
And then one last
Yes,
One
go ahead,
last thing
Dina.
that I wanted to say too, because we do have such a tight inventory market right now. So if anybody has something that's coming on, feel free to unmute yourself and just give a real fast shout out to what you have coming on, because a lot of you are sitting there with buyers, can't find houses, you know, things like that. So if anybody has something, feel free to unmute and just shout it out real quick. Nobody?
Everything's under contract,
That's nice. That's-
maybe. Ashley's like chomping at the bit. She's like, I got one.
Yeah, I have a couple. So I have a condo coming up in the Wilds that's near downtown Newport Richey. And then I have a 2 1.5 coming up in Holiday. And I believe a 4 3 in Spring Hill. So do you have anyone?
Wow, awesome. Yeah,
Very
reach
good.
out to Ashley Barrett. We'll get you all connected here. Ashley, if you want to put your info in the chat so anybody can reach out to you, feel free. Anybody else have any they want to share? We've
I have
connected
one.
some- Hi, Esther.
Oh, hi,
Esther.
Barry. Hi, I just listed a single family home in Plantation at Carrollwood. It's a 2-bedroom, 1 bath at $250. So that's a pretty good price point for that area. And the seller is willing to accept FHA and VA offers and do repairs that might be required for the lender.
Esther, did I hear you say he's willing to do a 2-1 buy down? Is that what I heard?
We
Sure.
don't
I
like
can
the
talk
word
to her about that.
repairs.
I can talk to her about that.
I
It
would
needs a
definitely
little
mark
bit
it.
of love. It has some peeling paint. So she said she would take care of that if the lender requires it.
Yeah, on an if it's an FHA buyer, they're definitely going to want that peeling paint scraped and painted.
Yes, I told
Doesn't
her.
even have to match, just scraped and painted.
I told her. Yeah, $250 for that Carrollwood area is amazing.
Yeah,
Yes,
it is.
All
Yeah,
right,
it is.
anybody else have any? Jared, did you have one? I saw you come on camera.
Yes, thanks. Yeah, I have one still active. The rest are pending, but I have, if somebody's looking for a large house, like right about 3,500 square feet, I have a 423 in the Pasco County side of Spring Hill. So right across the Pasco County line, and it's on an acre. And it's in a cul-de-sac too. So if anybody's interested in that, and I can drop it in the chat as well.
Yeah,
Nice. Drop it in the
Yeah.
chat. That sounds good.
Yeah, I have people look at, those are
And
harder to come
how
by.
much is that one, Jared?
Oh,
Yeah.
excuse me, 629.9. So it's up there, but I mean, it's that's the market value for it. So
Okay.
3,500 square feet. With
30,
acre.
yeah, yeah, and an acre, and no HOA. By the way, no HOA.
Wow.
Awesome.
Very nice. Very nice.
Anybody else have any? Just Jared, put your info in the chat. Lewis, you got one?
Yeah, I got a team listing. It's a 3-bed, 2-bath, with the garage, but the garage was half converted, half into an office. So the front half of the garage is more for storage, but it's nicely updated. We just had a price reduction down to 300,000. So if anybody's looking for a nice home here in Port Richey, real close to, I believe it's Gulf, well, not Gulf. It's right close to 19 near, right just past Ridge Road. But yeah, we're asking 300. It's a nice 3-bedroom, 2-bath with an office and a converted garage. That's a really nice home. So
I know the house. Yeah, you're right. I've been there. Did an open house there. That is a nice one.
yeah, they did some good updates.
Thank you, Louis, for sharing. Esther, someone's looking for the address of that Carrollwood property. Sunny's looking for it, so if you two can get connected there. Anybody else have any to share?
If
Hey, I
anybody
got
has
one.
open houses coming up, let Connie or I know too. Connie and I do open houses on the weekends.
Indeed.
Jesse, did you have one? I saw you pop on. Nice to see you.
Oh, there it goes. Hey, I'm like, I don't know if you can hear me. Can you hear me?
Yes.
Yes.
Okay. I have a commercial property, 9334 State Road 52 Hudson. It's a tire shop right now, and it's the business, the building, everything. It's right next to Dunkin' Donuts across from 5A high school. Between, yeah, it's like if you're coming from US 1952, you'll go past Little Road, and it's on the right hand side, like I said, right next to Dunkin' Donuts. And then I have I have a parcel of land. Everything else I've sold, but I have or under contract. I have a parcel of land in on Commercial Way, which is US 19 and Spring Hill. It's just under 20 acres, but it's probably like buildable of like 15 acres. It has to have everything done on it. So right now it's just a rough parcel of land. But it has a road to, or it sits back on US 19, but it's considered US 19. And so it's like I think it's 2.5 million. No, yeah, 2.5 million. But it's just under 20 acres, but buildable probably, like I said, like 15 if you have any like commercial ventures or anything like that. And that's pretty much it. I'm trying to think, do I have anything new coming? I don't know. I did a bunch of you do the presentations. I'm like, are they gonna call me? So hopefully I got new ones coming too. I'll let you guys know.
Awesome.
Good.
That's it. Thank
And
you.
of course,
Great.
thank you, Jesse. And of course, if you guys and gals would like to get connected with us on social media, if you're not, I'm happy to share your listings. We have quite a bit of following, so we want to help you promote those listings, obviously. And if you're looking for something in particular, let us know, because we have buyers lined up right now too, waiting and looking. So you never know. I feel like yes.
This is
Hi,
Betty.
Hi,
Hi.
Betty. Go ahead.
I have a beautifully renovated villa in Pine Ridge at Palm Harbor. It's 222. It's a little under 1,200 square feet, but it has an enclosed front patio and an enclosed rear lanai to a yard. And it's listed for 300, and it's well worth the 300. So I just wanted to put it out there.
Awesome. Awesome. Sheri, I know you got to sign off, so thank you for joining us today. So Sheri did a great job, didn't she? She gave us a lot of backside.
Fantastic. Thank
Yeah.
you so much, Sheri.
Yes, she did.
Yes.
So thank you. All right. Anybody else have any to share? And we'll stay on for a few minutes. No. Okay.
Thank you all
Again,
for joining. If
yeah,
we
thanks.
if you have questions or whatever else, please feel free to reach out to Barry. Kidding.
They know better, Dylan. They know better. Sign up, please, for our next month's Lunch and Learn. You won't regret it. The link is in the chat. Is that right? Yeah, the link is in the chat. I wanted to say the chat is in the link, but it's all good. Hey, I just had a birthday, so too many birthdays. So thank you all for joining. Appreciate all of you. And we will, and our Zoom for June, for those of you who just like to Zoom, we are going to be doing CE credits. So for those of you who need CEs, that was another request. We are going to offer those. I will tell you the date now so you can put it on your calendars. Of course, we have May 9th live, and we have June 13th will be same time, 11:30. You'll get 2 hours of CE for joining. I'll let you know on the topic, but I think we're leaning towards cybercrime right now. So it's kind of on the rise.